Variability. In this lesson, I would like to introduce you to the principle which was observed in the time of formulation of the impulse waves and corrective waves. This guidance applies to variability. Variability is widely used. According to the principle of variability, the analyst should expect that a similar figure of the next wave will be different than the previous one. Variability refers to the bull market and a bear market. The guidance of the volatility does not tell us what will happen, but suggests what should not be expected in the future as it has already occurred. This is consistent with another theory, one of the analysts, which says that the market is unpredictable. According to the rule of variation, where within the context of the second wave we had a wave correction of the basic structure of zigzag that has a violent nature, we can expect that the fourth wave will have a horizontal character, for example, the flat correction. Volatility can also appear as a variety of complexity. The principle of variation can also be observed on the example of elongation. In general, the first impulse wave is short, the third is much longer, and the final, fifth, is again short. The extensions which generally occur in third waves also occur as the first or the fifth waves, which is another proof of the rule of volatility. Variability is also present in a complex corrective wave. I mentioned this in earlier lessons. Here is an example. Wave W is a flat correction, wave X is a zigzag formation, and the last wave in the complex structure Y has the form of a symmetrical triangle. So we can sum up with the statement that preserving the principle of the variation in the analyses leads to an increase of the probability of the correct analysis.